Welcome to the Propertybuyer Podcast, where we explore the world of residential and commercial real estate to help you make better decisions about buying, selling, or investing in all types of property. Join me, Rich Harvey, CEO of Propertybuyer.com.au and multi-award-winning buyer's advocate. Our podcast features expert interviews, market trends and insights, and practical tips for navigating the complex world of Australian real estate. Whether you're a home buyer, a seasoned property investor, commercial buyer, developer, or simply curious about the property market, our podcast is for you. Join us as we share our knowledge, strategies and experience and help you achieve your property goals. Welcome to our next edition of the Property Buyer Podcast. Great to have you on board again. And as we head toward the end of June, end of financial year, we're seeing lots of things out there talking about tax. And tax and death are two certainties in life. But you can't avoid death, but you can minimise the tax that you pay. So today, you're in for a treat. We have an expert with us who will speak about all things about depreciation. A fantastic way, if you don't know about that, on how to minimise your tax. So we have Tyron Hyde, who's the CEO of Washington Brown, Property Tax Depreciation Specialist. Great to have you on board today, Tyron.
Thanks so much for inviting me, and it's going to be a treat talking about depreciation. I love it, Rich.
Excellent, mate. I know it's a topic passionate and close to your heart. So before we kick off with all the tax stuff, I just have a little tradition, which is our thought of the week. And our thought of the week, I'd love your comment on this week, is by John Lennon, who says, life is what happens to you while you're busy making other plans. What do you take away from that quote?
Well, I think for me, it means, you can just get so busy in your own life and you blink and you miss it. And I think sometimes we should all sit back and try and, achieve something out of the norm, and appreciate life. And for me, I did that recently where my family and we just before COVID, we packed up, and we moved to Bali and lived in Bali for a couple of years. And, I let other people run the business, and I just enjoyed, we moved to Bali to live, to take my daughter to a bamboo jungle school in Ubud. And it was certainly, it's an amazing school. It's just made of all bamboo. There's no aircon. There's drop toilets. It was a bit of a stepping out of the busy life that you get into in Sydney, or I am. And, unfortunately, as I've got back after COVID, you kind of, when you go on a holiday and you come back and go, did I just have a holiday?
Yeah.
Right? Well, that's right. But I was like 2 years in this heated, bubble in Ubud, in this jungle school. And sadly, when I come back now, it's a bit of a distant memory. But I think that's what it kind of means. We can blink and we can miss it.
Oh, mate, that sounds like you've done a wonderful opportunity, especially for your daughter and your family. What a great opportunity. Good on you. Love to hear the learnings from that, perhaps on another podcast. But let's get straight into it. We're talking all things tax today. Tell me, for our listeners, what is property tax depreciation? What is it? How does it work?
Sure. So just like any depreciable item, you can claim the wear and tear of an investment property against your taxable income. So when a tradie buys a ute for their business, they can claim the wear and tear of that ute against the business income. You as a property investor, you can claim the wear and tear of an investment property against your taxable income. But there's one major difference, Rich. And the difference is that when you buy a ute for your business, it's based upon the purchase price, right? But in property, the difference is 90% of what you claim in depreciation is based upon the construction costs. So you need to work out, not the purchase price. You don't base the depreciation on what you pay for that property. You need someone to work out what it costs to build, and that's where the starting point is. So when you buy that car from Kia, or ute from Kia, you don't go out and ring Kia and go, hey, Mr. Kia, how much did it cost to build that ute? Whereas property is different. You just need someone to work out what the cost is. And how it works in terms of what, as an investor, what it means to them. I'll break this down. If I was on $100,000 and you got a report from Washington Brown that said you can claim $10,000 in depreciation deductions, all along the whole way, you're paying tax for the whole year on $100,000. When you get the report, you give that to your accountant, and your accountant says, well, actually, no, you've got a $10,000 deduction here. You should have been paying tax on $90,000 throughout the year, and you'll get a tax refund. That's how, in summary, it works. And the good thing is, Rick, when you buy the property, it's already in there. You just need me to work out what it is, that $10,000 amount is. Whereas all the other deductions you get, you have to physically pay for them. You have to pay for your rates. You have to pay for your levies, etc. Whereas it's already in the property, so it's kind of like a free kick.
Fantastic. So that's a really good point you make just right up front. It's not about what you actually paid for it. It's about the cost replacement. And that's fantastic. So if you're a really savvy shopper, let's say, and you bought an oven for, $750, but normally they sell for $1,000, what number can you depreciate it at?
That's a very good question. With the plant equipment, it has to be based upon what you pay for it. You can't go and go, down the road, I saw it for $1,000. I want to start it there. It has to be based upon what you pay for it. And the benefit is that you've got the $250 discount. You can't have it. You can't double dip it.
Got it.
Even though a lot, people ask us, look, I know that would have cost me $50,000 if I got a real builder in to do it. All the time, Rick. All the time.
Love it. So this sort of leads me to my next question about the accuracy. Why is it so important for property investors to claim the right amount of property tax depreciation, and what's the consequence of not claiming it?
Well, a couple of reasons there. I guess the first thing is that if you don't claim it, no one can. No one else will. So you're just missing out if you don't claim those deductions. You can't. We often get some clients saying, oh, look, I bought this property and I know the previous owner didn't claim 5 years of depreciation. And that happens, right? And then they'll say, well, can't I get that? Can't I claim that? It happens all the time. But unfortunately, it's not. You can't do that.
It's not retrospective.
And in terms of no, it's not retrospective. It's only from when you own the property. In terms of getting it right, I can tell you now that the ATO constantly target this area, more so than ever right now, from my 35 years of experience in this. Not that we're seeing audit, but there's certainly, I know they're more cracking down on the repairs and maintenance, rather than depreciation. But the first thing that when you get audited, from what I've seen, is I'll say, have you got a depreciation schedule from a quantity surveyor? If it's a tick yes, that's a good start. Right? If you tick no and you've claimed depreciation, that's not a good start, Rich.
There you go. Fantastic. Yeah. Well, I think, and the consequence of not claiming it, as you say, you've left money on the table. You've left money on the table. Like every year, it's a bit like with your super, right? You can, at the moment, $27,500 you can put into super on the concessional basis. But if you don't put it in this year, you lose that opportunity. So same with your tax deductions. Like if you don't claim your maximum tax deduction, and you'd be crazy not to, I mean, the government honestly still doesn't know how to spend the money correctly. You're better off to really put it in your own pocket,
Yeah, that's right. Exactly. I couldn't agree more.
Tell me about depreciation rates. Like you must have, tax laws are like 65 volumes long. Does the ATO have like a list of prescribed dishwashers and ovens and prescribed rates? How do you work out what rate to depreciate things at?
So when I started this industry, I actually was one of the founding fathers of this industry, which I'm actually a fellow of the AIQS, which
awesome.
Which is an FAIQS, but these days I think the F stands for frigging old. But when I first started this, there was no actual list of what you can and can't claim. So after about 5 years of other quantity surveyors doing this, we all had different versions of what you can claim, what you can't claim. What is a kitchen a removable item, or is it fixed to the building? And the ATO saw all these different quantity surveying reports with all different items that we can and can't claim, and they came up with a definitive list. It was a fair while ago now, but it was about 15 years ago. So we all are working on the same list of what we can and can't claim. In terms of rates, yes, the ATO has given us a whole list of, this ovens will depreciate over 10 years and carpets over 8 years, etc. Bricks over 40 years. So there's a whole list of what you can and can't do. Now, what we're talking about is just the residential depreciation numbers, right? But the volumes are huge. It goes into every category of every industry, manufacturing, there's pig farming separate. You can, down to how much you can depreciate a garden gnome. I kid you not.
Wow.
Right? So it is very detailed of what you can and can't claim. We are kind of governed in that regard.
So that's an interesting point, because it's like people just say, oh, look, my accountant will work it out. Honestly, that's just a fallacy. Look, no disrespect to accountants. They're great, but they need your report. I mean, I've always used a depreciation schedule from yourselves and found it fantastic. But you've got to get it right, because the ATO, as you say, is cracking down, particularly around the difference between repairs and replacement. And capital improvements. That's a very important mistake that people make. But tell me, what sort of tracks the highest rates of depreciation? Is it the dishwashers, or is it the carpets? What things really wear out the fastest?
Just before I go into that, just on the accounting issue. So accountants aren't actually allowed to estimate construction costs where the costs are unknown. They can't do depreciation of the building. There is a ruling that says quantity surveyors are the go-to people for that.
Okay.
Which was a wonderful ruling. It happened in 1997. And I wrote my thesis on this topic in 1994. And when this ruling came out, I went, woohoo!
It validated you're a futurist, ahead of the curve.
I was a futurist. In terms of what depreciates faster, the things that are easily removable, so the ovens, dishwashers, but even more so like light fittings and blinds. It makes sense. Things that are going to wear and tear quicker, that you've got to replace quicker, are the things that depreciate faster. Things that are going to last longer, like bricks, concrete, tiling, roofing. That's the slow 40-year depreciation rate on those things. But that's how it works.
Yeah. So you mentioned there's been different rulings over time. Like, do you think the government, so tell me what's firstly changed with depreciation deductions over the last 5 years? I remember you woke up one morning not long ago and freaked out when there was a change. Tell us about that.
I still can't sleep, Rich. I've got to be honest with you. This was it was in 2017, May something, 2017. Indebted in my head. So it was budget night, and no one saw this coming, and the government on budget night said, as of 7:00 tonight, no property investor can claim depreciation on things like ovens, dishwashers, etc. if they're second-hand. You can in residential property. You can only claim those if you buy it brand new, which in my view was a bit silly. And the Treasury Department invited me in to discuss it with them, and they really were just doing, the industry consultation. They were never going to change their mind.
The token consultation.
Right. Yeah, we approached the industry. They already made the decision, right? So it is a major difference now between buying, in depreciation terms, buying a property that's brand new versus a one-day-old one, which is crazy because the government also says carpet's going to last 10 years, for instance, but if I buy a property that's one day old, it's lasted 1 year in terms of the depreciation value. So it kind of favours new properties, which I don't know if it's a good thing. But they didn't. And the other bizarre thing, they didn't change it for residential. They didn't change it for commercial industrial. So we can still revalue 100-year-old commercial properties, right? Wow. Which is crazy. So to put this in perspective, if I was to buy a brand new property today for $1 million, I would and I bought it for $1 million and as an investment property, I'd be able to claim about $25,000 in depreciation deductions. If I sold that to you, Rich, tomorrow for one day later, so it's only 1 day old, you'd only be able to claim about $8,000.
There you go.
A big difference.
Huge.
A big difference. So, but I'm not telling people they have to base their investment decisions on what the depreciation numbers are. I'm just telling you this is what's happened. And still today we serve our clients, and still I'd say 90% of people still don't know, which is
interesting. It's a very confusing topic, and that's why we're talking about it today. But really, I appreciate you taking the time to help educate our audience.
I love it.
And tell me more about the whole government angle on it. Do you think the government is likely to continue to tweak and change depreciation rates in the future? Like, do you think they'll just remove it completely for second-hand property, for example? Or change it? Yeah.
Could do. They could do. I think. The depreciation is a tool the government can lever to promote activity in different industries. How this actually started back in 1979 was they wanted more hotels built. So hotels, for instance, get a 4% building allowance, which means the hotels are saying that the structure only lasts for 25 years, even though it's the same bricks. But it is a tool that the government can lever depending upon where they want more activity. So yes, I think they could. I think they could cancel the building allowance on second-hand properties, which, if they do, they do. But what I think they could do even further, they could increase it more on new property. Because at the moment, as you know, there's not enough new property being built.
Exactly. That was going to be my next question in a way. Could this be a policy tool to increase supply?
Absolutely.
And it could well be.
Because what they could do, because as you know, to get developments off the ground, you need pre-sales, right? And a lot of people with the Mascot Towers, all these disasters, not a lot of people are rushing in to buy new property, right?
Off the plans, on the nose, isn't it?
On the nose, right? Yeah. And so one of the only ways that they used to be able, you could sell new property is based upon it being cash flow positive because of all these depreciation deductions. So they could increase the building allowance to 4% as opposed to 2.5% to make it even look more attractive. And the reason they could do that is because when you claim the building allowance, you have to factor it back into the capital gains tax equation anyway. So they kind of get it back anyway. So it wouldn't be a lot of skin off their nose, but I don't think, so they certainly could do that.
Okay. Yeah. Let's just talk again about second-hand property, because there's still a lot of confusion, even though there's been that amendment about not being able to claim the fittings and fixtures on older properties. But my understanding is that you still can if there's been a renovation, right? So tell us about what depreciation is available on established or second-hand properties. We really appreciate you tuning in to the Property Buyer Podcast, and I hope that you're finding our expert interviews helpful. So that we can keep providing this information and growing our audience, we rely on word-of-mouth recommendations. If you found this information useful, could I please ask you to share this podcast with your friends, family and colleagues, and ask them to subscribe to the Property Buyer Podcast. It would be a big help, and we'd be very grateful for your support. Thanks once again for sharing the links. And now, let's get back to the podcast.
Any property built after 1987, you can still today claim the structure of the building. And let's put this in perspective. The structure of the building, the structure is the brickwork, concrete, not the ovens and dishwashers, that stuff. It's the roof, etc. And that represents about 90% of the claim. So it's only the 10% that's been that's been removed for second-hand property. The problem is that 10% is the stuff that depreciates quicker, and that it makes your cash flow better because you get a higher depreciation in those early years, right? That's the difference. So, but you can still definitely claim building allowance, structure, and it's still worthwhile. It's just not as much as it used to be. If you buy a second-hand property and you renovate it yourself, yes, you can claim whatever is, even though it might be a 100-year-old Paddington terrace. If you buy a brand new oven from Harvey Norman and put it into your brand new terrace, you can still claim that. So even though the property structure is second-hand, you can still claim the depreciation if you buy the stuff yourself. And if someone has done if I was to buy another example, if I was to buy a 1900 Paddington terrace and the previous owner did a renovation 5 years ago, right? And they spent, say, $500,000 or $250,000, whatever it is, on that renovation, we would go out and go, oh yes, we think that renovation happened 5 years ago, and that client spent about $250,000, or that vendor spent $250,000, and you will start the depreciation from when you settle, based upon our estimate of 5 years ago of what that person spent on that renovation.
Okay. So just on that renovation stuff, so how do you estimate that? Is there something you can look up, or do you kind of just get a microscope, or some carbon dating testing? Like, how forensically do you get in terms of when you don't know that the date that's been renovated? How do you actually go out there and do that?
So when you graduate, you get a magic wand. It is one of the hardest things we can do, because especially if it's just an internal renovation, right? If it's a major renovation, there'll be council documentation, etc. But internal renovations where you don't have to go to council, it is really, and there's been no information transposed over from the vendor. It really is our own skill set of working those things out, looking at, of our hundreds of thousands of inspections, looking at what, maybe it might be the type of tiling used, what was in trend at that time, that type of thing, right? But it is not a precise science, and that's why the ATO accepts our estimate.
It might be the make and model of the oven, or
exactly,
or the paisley tiles or something like that.
Yes, exactly. But it can be tricky, definitely.
Okay, excellent. Okay, look, we're recording this just sort of toward the end of the financial year in June, and it's everything. Everyone's talking about tax. Everyone starts looking at their pay slips, going, "Gosh, look, I'm paying so much tax." And but what are some of the common tax mistakes that you see property investors making in their claims, or that you hear about?
Sure. So I guess the first thing is not getting a depreciation schedule. That would be something to do. But at the moment, firstly would be not knowing the new laws. So when we're speaking to property investors, they still think they can claim all the depreciation on the second-hand items. But in terms of what the ATO is targeting this year, I can guarantee you they are targeting repairs and maintenance. It is, and I can. Two of my staff members, it's not just anecdotal, two of my staff members have been audited. Since the ATO put out a press release saying we're targeting repairs and maintenance, they've both been audited for claiming repairs, and they did that. They did their own report, so I'm pretty sure they're right. Perfect. But they are targeting. Yeah. And one of the major things that people need to understand about repairs is if it's called initial repairs. There's a thing called initial repairs, and if I was to buy an old property and it looked like, the bathroom tiling, I don't know, something was leaking, maybe the bath was leaking and I replaced the bath, etc. Right? Because I bought it because I just bought it, it is not a repair to that bath. It is an initial repair, which means it has to be over a 40-year period. However, if I had that property for 3 years and the same issue happened and I fixed it, that would be a repair. So the government says that because you didn't own it and the wear and tear or the damage didn't occur when you owned it, right, you can't claim it as a repair. That's the difference. Whereas if you get out I'll give you another example. Say I bought a house today and the hot water system was in need of the maintenance. So I got a plumber out, right? On day one, he fixes the hot water system. It's not a repair, even though it might have been $200. But if I did the same thing again 6 months later, it'd be a repair. So that's what people need to be considerate of. They're certainly cracking down on that.
Excellent. No, really good advice there. Tell us about old versus new property investment. When you're buying a new investment, or when you're buying an investment property, how much importance do you think an investor should place on depreciation? Do you think that depreciation should be a deciding factor, or is it like a nice to have, the icing on the top of the cake sort of thing?
Well, you're probably asking the wrong person, but look, if I'm honest, it shouldn't be a factor. I don't think it should be a factor, Rich. I think there's many other factors that I would consider before I was to buy an investment property. Depreciation wouldn't be top of the list.
Wow, I've got to compliment you on that answer, because you run a depreciation company and you say it's not the most important factor, and I totally agree.
Nowhere near it.
Yeah, unpack it for me. Let's unpack it for our listeners. Why is that, do you think?
Because I think there's many other, look, for starters, I don't think it's actually a huge factor for a lot of people buying secondhand properties either. I think it is a factor for people buying new properties, but there's many other factors that should be considered in buying an investment property, like what is the land content to the purchase price, with the location of where it is. I could think of 50 things I would think about before I bought before I was worrying about what the depreciation numbers are, to be honest. Even though that's my business, right? But once you've got it, what I'm saying is once you've bought that property, then you need to get a report to help your cash flow. But don't make your decisions whatsoever based upon what the depreciation numbers are. It really is an icing on the cake thing, right? And I'd also be wary. I had one client ring me up once and she said, Tyron, I've been to 8 different building sites, because we give a lot of reports to developers to sell properties, right? So we say, okay, if you buy this $1 million property, Mr. Investor, you'll get in year 1, $25,000 deduction, year 2, $20,000. And then, and we do that for a lot of big developers. And so this one client rang me up once. He said, Tyron, I've been to 8 different building sites, and I saw all your reports on everyone. She goes, and I've got them all here. And this particular development site says you can get $25,000 in year 1, which was more than all the others. She goes, so that makes that one the best investment, doesn't it? I said, no. I swear that's what, and I was like, no. It doesn't work like that. No, it's just a number. Don't think of it like, there's many other factors you need to consider.
Good on you. Yeah. Well, I think this is the point exactly that I'm pleased you made it, is that it gets the tax depreciation on you is blown out of proportion. I mean, I remember back in the day, the spruikers on the Gold Coast would be flying people up, and the first thing they would talk about is the massive tax depreciation. And look, saving tax is a great thing by buying property investment. Anyone that's earning a decent income should be buying properties and reducing their tax legally, using all the incentives there. But the problem is it gets blown out of proportion. And I think that's the key point that our listeners need to take away from this.
A lot of the times over my life, sadly, we do a lot of work with sometimes, or we try to avoid them sometimes, but a lot of these people selling these house and land packages in not the nicest areas, and we see 10 years later that it's the same value as what it was 10 years ago, right? And part of it is based upon this selling of, the big depreciation numbers. Sometimes they call it even a government incentivized program. No, it's not. I don't know. It's like, no, it's not. It's just depreciation. And,
See, that's a really good point. See, I mean, someone who's bought a house and land package out at, past, the Ripley Valley, out the west, out past Ipswich, for example, on a 300 square metre block of land, and they paid back in the day $400,000 and it might be worth $450 today. Sure, they've made, nice little tax deduction, but they've made very, very minimal capital growth. You're far better off to buy second-hand established properties. I mean, in fact, Tyron, 99% of what we buy for our clients is established properties, because we believe that the land content and the location is critical in getting the right sort of capital growth for our clients. So, but tell me a little bit about
one thing I've noticed on that, I actually think it could, because when we do all our reports, we analyse, we look at all the past sales history of every property. We've done 300,000 reports, Rich, so we look at a lot of data. And one thing I've noticed is that if it could be a strategy to follow the house and land spruiker, right? Because what happens is after about 10 years, it's still flatline. And that's when these people are tearing their hair out, and they throw everything into the bin. I've got to sell this property, right? But what I've noticed is at about that 10-year period, that's when it starts to actually get some growth.
Exactly.
Right? So you could actually, what you could do is follow some of the spruikers that are on all the right, and just wait, put them down where they're buying now. Yeah. Go there in 10 years' time and buy.
Well, to be actually honest, that's exactly what we've done in some of our cases. We've done very well. We've found the stressed out investors, and we've bought very well just before it's gone up. So yeah.
And the other good thing about that is the 10-year period. That's when I also advise someone at the time, what would be your kind of go-to property? I would actually say about a 10-year-old property. And the reason is that you can get great sales data and actually know what the value is. Whereas if it's brand new, it's really hard it's just what the developer can put on a block of apartments. This is what I think I can get, right? Yeah. Whereas a 10-year, you get great sales history and actually go, well, this is what it's actually worth. And the other thing is, for me, the ideal kind of property is something that I can spend 20 to 50K doing up, right? Do it myself, no risk. I don't have to get a builder involved. It might go broke. It's not too big, and it's a bit of a makeover. And then all that stuff is highly depreciable as well. And you're putting in a new oven, new carpets, and making it. I think that's the biggest bang for your buck you can get is that 10-year-old property.
Love it, fantastic. So tell me a bit about your personal investment strategy and philosophies. Are you an active investor, and what sort of motivated you to get started with property investing?
Well, I certainly have been an active investor. I was just looking at this the other day. I've bought 22 properties in my life. Don't have them all now, but in terms of what motivated me, well, I saw my father lose all his money. Failed property deal in 1987. My father was the smartest man I've ever known. He had 4 degrees. He was in the Air Force for 12 years, and then he became a lecturer in psychology. And when he was about 55, he had a stroke, which is about my age, which is why I'm on the blood pressure tablets. And he had paralyzed. He had paralyzed on the left-hand side completely for most of my life. So for the last 20, so when I was 13, he had the stroke, and so for 17 years he was completely paralyzed, crippled, and he used to make me get a pin and prick his arms to see whether he could feel it and stuff like that. And anyway, so they retired him early, and he got a payout of $250,000 in 1987, and invested it all in one company, state mortgage, and and then the interest rates went up to 17%, and they were advertising themselves as safe as bricks and houses. We're investing in property. They were, but what they were doing was putting into mezzanine finance, right? And so when interest rates went up to 17%, that all fell over like a deck of cards, and he lost pretty much everything. So the stroke didn't kill him. Seeing him lose all his money, and I think he ended up with like 7 cents in the dollar. That's what killed him. That kind of motivated me to get into property and educate people, and hopefully, save people a few bucks. So that's what kind of motivated me to get into this property market.
Excellent. Yeah. And do you have a particular strategy that you use yourself? Do you buy brand new? Do you buy established? Do you do developments? What sort of strategies do you use yourself?
Well, to be honest, it's changed over the years. Because I started with nothing. My first strategy was to get in at all costs, right? Because I was in actual fact, my first property deal was the best deal I ever did. Because I was working. When I first started in the quantity surveying industry, it wasn't in depreciation. I was a traditional quantity surveyor, which means that we would work for the bank as a consultant, as a project auditor. And so if you borrow $10 million from a bank to do a development, the bank just doesn't give you $10 million. They'll say, okay, how much is it going to cost to build? They'll get an independent estimate from someone like me, and then we'll go out every month and do a progress claim, and certify, you've done $1 million worth of work. That will pay the developer, pay the builder, hopefully the subcontractors if everything goes well. And I was doing that on one of these projects, and I put like $1,000 down on this unit, and because the builder went broke, and I helped the developer project manage it out to the completion. And by the time it finished, it'd gone up like $100,000, right? And I put 1,000 down. So when I sold it, I turned that $1,000 into $100,000, which was great. And I did that with a partner as well at the time. And so the first 3 properties I bought were all in JV, not JVs, but just, like, hey, my brother, my girlfriend at the time, let's buy a property together, pool our 3% together because we hadn't had any money, and just got into the market that way. And I guess over time, what's happened is it's evolved. I've gone from there to, a bigger place. And so I haven't really this is my strategy. It's been more about what I can get, the bigger, the nicer, the shinier, but I don't go, I want to buy a new property, but also even like commercial properties. So I've bought commercial properties for my office. It's been more about what I needed.
Yes.
And as time's moved on, I've sold some of those properties and now I've just reduced my debt to I've got, I think 2% gearing on my portfolio. So, which is, I guess, which I guess is, look, I'm not the model for going out and, going out and getting a lot of debt. I guess as you move on in life, you kind of, I sleep, put it this way, Rich, I sleep a lot better.
Yes.
Well, having a lot of debt.
That's really good. I mean, that's for everyone to decide on. There's their own level of leverage and level of risk, and so good on you. So that's great. And just a little bit more about investing. Do you have a particular method of deciding where to invest? Do you choose any particular locations based on any sort of criteria yourself?
Yep. So we are looking at the moment, but we've just, because I'm doing my own podcast, I've been speaking to a lot of people, and what I would do at the moment, I tend to do all my investing, whether it be shares, everything. I tend to do the complete opposite of what everyone is doing. So at the moment, I would be running from Perth myself because my Facebook feed is just full of Perth, right? And some of the people doing Perth, I worry about. So I would be looking for myself. We're going to start looking in Melbourne because I like the fact that no one's liking Melbourne at the moment. I like the fact that I like the fact that the gap between Sydney and Melbourne has never been greater. I think that the fact that at any time the government could change the stupid land tax laws they've got there, will put a rocket up it, and I'd rather buy before they put the rocket up it rather than after. So if anywhere, I'll be looking in Melbourne at the moment, in blue chip. But so that's what I'd be doing in terms of that.
No, I've talked with quite a few people about that, and we, again, I think Perth does have maybe a couple of years left to run, but I think it'll definitely run out of steam. I mean, a market that's gone 20% per annum is not sustainable, and I think you always look at the differential between the capital cities, and Melbourne has just been completely lackluster in performance. I think it was 2 or 3% last year, and 2 or 3% the year after. It's got a COVID hangover basically, and unfortunately the government's in a lot of debt. But I totally agree with you, and we're putting a lot of our strategic investors into Melbourne that have got the ability to buy properties that aren't perhaps as highly cash flowed. You can still buy, we bought a unit the other day, and we got a yield of 5%, 5.5%, which is pretty decent. But, if you're buying houses, you're going to get sort of 3, maybe 4%. But we're doing a strategy ourselves in Melbourne at the moment where we're buying houses and adding granny flats, and because they've changed the legislation. But I agree overall. I'd agree. Melbourne's a great pick at the moment. So, yeah.
The funny thing about not the funny thing, but the sad thing is when you see something like Perth, what happens is you see a bit of growth, right? We've seen it for, Perth was dormant for 14 years, and now it's it's suddenly like Perth disappeared on the map in Australia, right? It's a bit bizarre. But what happens is the spruikers see this growth and this momentum, right? And then they start going, Perth, I've got 3 spots in Perth, and people are going to go there because it's easier, right? They just are relying on someone to do this house and land package over in Perth. And so the spruikers come in at this time of the cycle in that city and go, yes, I've got Perth bucket, and everyone thinks everywhere in Perth's going to go. There will be good areas in Perth, don't get me wrong. But unfortunately, there's going to be some people that are going to get hurt in Perth now, I can tell you that much.
That's it, yeah. And talking about property types to invest in, do you have a particular view on what would be a good property type? I mean, is it apartments? Is it townhouses, terraces, houses? Do you apply any particular criteria for choosing properties yourself?
I think you've got to have higher land content. Even though I'm all about depreciation, you really need a high land to purchase price ratio. For me personally, I also look, which I know a lot of your listeners aren't going to be able to do, but I look at the replacement cost or what it would cost to build or replace that property as well, right? So for instance, the house I'm living in now, I don't want to use the numbers, but I bought a property. I could tell the difference between what the land value was from the council, right, and what I was paying, And it was only a 6-month-old property. And I'm like, there's something wrong here. This is good because I knew the build costs on this property would be like $4 million, $5 million, right?
Yeah.
But it wasn't there, the differential. So I factor into, and it's come true because it's already gone bananas because I just knew that because construction costs have gone through the roof as well. So then the replacement costs now would be even further.
Yes.
So I factored that into the component, but I know a lot of your listeners are. So for your listeners, I would be looking really at a high land ratio as you can in a good area. But because I don't subscribe to the myth that they're not making any more land, right? That's not completely true because what people do is they buy farms and they chop them up and they subdivide, right? They are making more land. So you can't just think that I buy property anywhere, it's going to go up. It doesn't work like that. You got to buy good land in good areas.
It's all about proximity.
Yep,
And
I agree.
And just finally on your investment strategies, have they evolved over time? I think you've sort of touched on it a bit before.
Yeah.
You've called commercial property. You've kind of evolved.
Yep.
I mean, because I think a lot of investors get a bit impatient. You know, they listen to so many podcasts like this and they read the media and, you know, when they get to age 30, they think they should have 13 properties in their portfolio. And I think, you know, for me, I just say to people, just be patient. You know, if you invest in property investing will do the heavy lifting for you, but don't run ahead of where you are. You know, you've got to learn to crawl before you walk, before you run. How has that sort of philosophy worked for you in your own life?
Well, I guess as I've doubled down, as I said, I've reduced my debt and put it into the few. I'd rather a few good bigger ones than I couldn't think of anything worse than having 100 one-bedroom apartments in Cairns. I'm sorry, there are things worse, but the paperwork and like why wouldn't you rather if you had 100 properties in Cairns, right, or wherever it is, of little things that have all those. There is a lot of rate work in running sometimes, probably not a lot of work, but there's there's a lot of counting sometimes to do with that. And if you had 100 little individual properties, you're going to have a lot of expenses as a ratio rather than having one $5 million commercial complex that's got 10 different tenants, you know, and that de-risks it in itself rather than having all these little ones that sometimes might take a little bit longer to sell because they're not in the best areas, et cetera, et cetera.
Exactly.
So,
exactly. No, really good points. Back to tax depreciation. What would it cost the average investor to prepare a depreciation report? I guess, what do you charge? And would you recommend that EQS prepare a schedule or just get the accountant to do it?
Well, it depends on the property, obviously, and the type. But what we also need to consider here is that when the laws changed in 2017, when we're really claiming under the structure, not every property now needs to be inspected in order to get the maximum depreciation. For instance, we do a lot of work with developers and we've got a lot of the costs already. So we pass that saving on to the client. So roughly you can pay for a residential property, you should be paying somewhere between $400 to $770 for a property. And that would depend upon the type of property, where it is, how big it is. Sometimes we offer, the industry's gone a bit funny in some ways where a lot of firms just offer a fixed price for all type of property, which I kind of find bizarre because if I bought a 5-bedroom house in Vaucluse, as an investment property, and people do trust me, as opposed to a 1-bedroom studio apartment in the city, it's going to take a lot more time to work out the costs and give you the best report for that Vaucluse property as opposed to a little 1-bedroom thing. So we look at every individual property and price it accordingly to the volume of work that involved, and sometimes we offer a premium service where someone like I'll even go to that property myself. I did an inspection yesterday, Rich, and I was because the property deserved it, because when everyone's just giving this flat rate, they're sending out sometimes just kids, you know, like to take a couple of photos. So I'm lifting the lid on the industry there, but I think we should be looking at each property individually and make a decision upon that property as in terms of how much we price it.
Yeah, perfect. Well, I mean, at the end of the day, $700 for a report when you're getting, you know, thousands and tens of thousands of dollars back in 1 year as a tax deduction, it's a no-brainer. So the metrics, and it's tax deductible as well. Yep,
tax deductible. There you go. And we also say we don't get you twice our fee in the first year. We don't charge the client anyway, so you still get a report, but we don't charge.
Perfect guarantee. Now, just to finish up, you've made an amazing business, Tyron, out of you've been doing it for 40 years, and I think you wrote a book with a great 2-word title called Claim It. Love that. Love your brevity in that title. How have you done it? How have you built your business, and out of a topic that people find quite difficult or boring to talk about?
Well, it's funny. Well, firstly, I had to rewrite that book because when the laws changed, Rich, I had to rewrite it because half of it was incorrect anymore. So I rewrote it and I called it "Keep Claiming It."
Keep claiming it.
Keep claiming it.
That's a 3-word title, right?
Yeah, that's right. It was actually both of them my wife came up with. She is a writer, so she's quite clever. How have I done it? I love saving people money. I actually find it really interesting. I love when I first started this, I would sit up all night and just read tax laws, and I've had some and just so I can pass on that information to my investor database. And what's happened, Harry Trigboff is one of my clients who, I don't know if people know, they probably know who he is. He's Australia's second richest person. He owns Meriton, and he's always tested me. And so doing his big projects, and he's not depreciation schedule. There's depreciation schedules, and then there's depreciation schedules. There's the standard one-bedroom unit that you
steroids, I'd imagine.
And they're complicated. Like when he bought World Tower, he bought that site with 4 different buildings in there, right? With 3 different builders who've gone broke. How do you work out those things? So it's not always that simple, right? And so and for me, getting my teeth into those kind of complex projects is really interesting. Like we did some pretty interesting stuff. I love it. I guess hopefully my enthusiasm for this. I did a podcast the other night. I did a live podcast the other night, and I think the general comments were, "Hey, Tyron, how can you be so enthusiastic about this topic?"
Great, mate. Well, that's wonderful. I mean, it comes through your passion, your intellect for it, the fact you did your thesis on it, mate. It's in your blood. Yeah. So well done. That's wonderful.
It's a bit weird, isn't it, though?
I love it, mate. So final question I'd love you to share with our audience. Can you tell us maybe the best piece of investment advice you've ever received?
I'm glad you asked this question. All right. So as I said, one of my clients is Harry Trigboff, and he's worth $26 billion now. He owns Meriton. So to put that in perspective, if you were to merge Suncorp Bank, which owns Vero, AMI, API, all those insurance companies, with AMP, and you merge them together, you still haven't reached his personal net wealth, right? So when he invites me he made $1.4 billion per hour over the last 4 years. So when he invites me to lunch, I'm scared he's going to send me an invoice for 2 hours, right? When I get back to the office. But he said to me at one lunch, he said, Tyron, and when Harry talks, he ends his sentences with a higher intonation at the end.
Right.
Tyron! He said, Tyron, do you want to know the secret to my success? Now, Richard, I'm not going to say no. Yes, Harry. Of course. Harry, yes, what is the secret to your success? He said, listen to me. He said, Tyron, when times are bad, I buy land. By the time I get development approval, times are good again. I'll say that again. When times are bad, I buy land. By the time I get development approval, which could be 2 to 3 years in his case, times are good again. Now, what does that mean? That means ignore the noise. Back yourself. Good times will follow bad times will follow good times. You see, for someone like Harry, who not only who buys the land, then develops it, and then keeps half the stock himself, it's not a question of whether you time the market or have time in the market. For someone like Harry, he does both. He times the market and then has time in the market. And if you can do that, Rich, I think you found the holy grail.
Mate, love that piece of advice. That is so wonderful. And that's very timely at the moment because we're finding a lot of people are hesitating on pulling the trigger on buying. We're talking to a lot of people, neighbours and family members, all with good intentions saying, oh, look, I think you should just wait till interest rates drop. But I can tell you, the minute we get 1 rate cut or 2 rate cuts, guess what's going to happen? The market is going to absolutely re-accelerate. And instead of trying to buy a property when 2 or 3 people are bidding against you, you're going to have 10 or maybe 15 people at the auction, just like Harry's advice, ride out the cycles. I think that's a wonderful piece of advice. Fantastic, mate. Thank you so much for sharing that. Well, mate, that comes to the end of our podcast, mate. Been lovely to have you on. Great. And if people want to get in touch with you, tell us your website.
www.washingtonbrown.com.au.
Fantastic. And look, you've written a bunch of stuff. Actually, we have one of your calculators and a few of your reports on our website on propertybuyer.com.au, so you can jump on there and grab them. But Tyron from Washington Brown, thank you so much for sharing today. Been wonderful, and we look forward to having you all back on the next edition of the Property. Thanks for being with us on another Property Buyer podcast. If you have a question you'd like to ask, please click on the SpeakPipe link and we'll answer this during the next episode. If you're looking to buy a residential or commercial property in the near future and would like to get the added advantage of having a buyer's advocate on your side, then please reach out to my team today and send us your inquiry and we'd be delighted to help. Please visit our website at propertybuyer.com.au where you can stay updated with all my latest market updates, weekly blogs and live suburb profiles to help you make better property decisions. We look forward to connecting with you again on the next Property Buyer Podcast.